Hello everyone, it's Saturday morning the 22nd of February 2020. I'm recording this quick video from home. My microphone broke down a little earlier, so I'm relying on the webcam microphone on this computer. I hope the audio quality is going to be good enough. There are a few interesting things I'd like to mention about what's happening in the markets, so hopefully the audio quality will be okay for us to be able to do that. So without further ado, let's take a look at our disclaimers, make sure that you've understood those, and let's take a look at what's happening in the markets. So let's start with the S&P 500, and this is the 3-month view. You can see that the 20-week cycle trough over there at the end of January has been confirmed, and if you have a look at the information in terms of the sequence, you can see that the system is suggesting that the current interaction, because prices dropped below the 20-day FLD, is probably a category B interaction, but that we should consider that this could be an early D category interaction, and that's a very important consideration in my opinion. And so let's take a look at the 6-week view, because I have a few things to say about this. I think that the chances that we are currently in a D category interaction are actually really very high, and let me point out the reasons why. First of all, if we look at the recent wavelengths that have been occurring in this market, you will see that the 40-day cycle has recently averaged 30 days. The cycles have been running short, and it's something we've spoken about before, and it's come up in all of my market update videos recently, that the cycles are running short, which they tend to do when you have a bullish market, which this market has been. And you can see the 80-day cycle was 60 days long and so forth. We know that this 20-week cycle trough on the 31st of January came in early. It was I think about 10 days early, perhaps on the 80-day cycle, even a little earlier on the 20-day cycle, something like 16 days early. The point is the cycles are running a little bit short at the moment, and so there have been 21 days, I believe, since the trough on the 31st of January. So that's 21. Let's see if I can write 21 there. And the average length of a 20-day cycle, which is when we would expect the category B interaction to occur at the time of the 20-day cycle, the average length is 17 days. And you can see that the recent average length over here is just under 15 days, 14.8 days. So therefore, to be holding out for the fact that we're still coming into a 20-day cycle trough at this point, I think would be a mistake. Of course, it is possible. The wavelengths are dynamic and they will expand and they will contract. However, I think it is much more likely that this 20-day cycle trough has already occurred. I think it's possibly occurred all the way back here on the 10th of February. So that would have been only, I guess, about 11 days in, so it would have been really quite short, or it could have occurred on this little drop down over here. I'm not sure what date that was. That was pretty much sort of on that bar over there, about the 13th perhaps. And so in my opinion, it's quite likely that the 20-day cycle trough has occurred. We would expect it to occur at about 15 days if the cycle wavelength is remaining constant. And so at 21 days to still be holding out for that 20-day cycle is probably a mistake, which means that we should put a little more emphasis, in my opinion, on considering the early D category. In other words, prices coming down into this 40-day cycle trough, okay, which is expected over here towards the end of this month, pretty much the end of next week, perhaps the beginning of the week after. So in my opinion, it's very likely that we're coming down into that 40-day cycle trough already. You'll notice that the recommendation for the next trade is for a C category long entry, and it is using the level of the FLD. And the reason the system's designed like this is, in this kind of situation, if this was in fact a D category interaction that was behind us and we were moving down into the 40-day cycle trough, then what would be the next trade? Well, it would be an E category trade that we would take to catch the bounce out of the 40-day cycle trough. and the E category trade would in fact have exactly the same sort of levels and things as that C category trade. So it doesn't make a huge amount of difference. So in my opinion, that D category interaction is now behind us, and we're looking at the E category trade coming next. Now I've got an interesting comparison to make, and that is with the Euro stock market, which is of course slightly different. It works with a slightly different rhythm to the American markets. But here you can see an 80-day cycle trough. There's been some pinning. I won't bother speaking about that in this video. But the 80-day cycle trough has been marked there for the end of January, and 21 bars have elapsed. But you can see the sort of instructions for the trading is that the D category interaction is now the interaction that we have just experienced. In other words, price is just crossing down below that 20-day FLD. And because price is currently straddling the 20-day FLD, there is no E category trade identified yet, because we're still sitting on the FLD and we need to wait for price to move a little bit away from it. But I think if we take a look at the 6-week view, you will see that in fact, here we go. Here is that 40-day cycle trough, which has been running even shorter in the European markets at 27 days instead of 30 days as it was in the US markets. So the likelihood that we're coming down into this 40-day cycle trough is certainly much higher in the European markets. And of course there's commonality between the US and the European markets. So that pretty much reinforces my opinion about this. And one of the markets that I'd like to take a quick look at is the Australian market, which, as I mentioned in a recent update video, has a slightly different analysis again. You can see here on the 7th of January, we've got a 20-week cycle trough. And so the recent drop down below the FLD was the D, and then we had the E. So in fact, what we're experiencing now or next would be an F category interaction according to this analysis. Now the software is positioned the 40-day cycle trough over here at this slightly questionable position. It might be better positioned over here, but nevertheless it doesn't in fact change our trading at all in terms of the fact that we're expecting an F category interaction to occur next. And so if the Australian market comes down fairly hard down into this 20-day cycle trough over here, it would certainly make sense if the other markets around the world will move with some degree of commonality and will tend to have a slightly stronger move down than would be expected for the move down into the 20-day cycle trough. There's something else interesting that is happening in the Australian market that I thought I would take a moment to speak about. It's this no trade recommended. Now we often get emails about this asking why it is that no trade is recommended. How can that be? So the reason why is explained in one of the training videos, but let me just run through it again quickly now. We calculate the target for the move on the basis of projecting where price crosses down, and you'll often find this no trade recommended happening over a weekend. The reason for that is because the software assumes that the cross will only take place on the Monday. Of course, now it might take place over the weekend, in which case we would achieve a slightly lower cross. The level at which price would cross would be a little bit lower. But assuming that price only does cross down on the Monday, that means that our crossing level would be over there. And in fact, you can see that you can read the level of the chart, of course, 7118.35. And our recent peak, as you can see, I've drawn on the chart there. Therefore, we would project a target downwards an equal distance below, which would be somewhere over here. In fact, there's the level 70.35. So you can read the levels, of course, off the chart. And so that is our T2 target. Now, our T2 target is our cycle target generated as a result of crossing the FLD. However, we also have a rule that we do not enter within the range of the previous day's trading. In this case, the previous day's trading was Friday's trading, and we don't enter a trade within that range because price will often move down and sometimes slightly exceed the previous day's trading range. And so, of course, we have a rule that we don't enter within the range of the previous day. And so our entry would not be at the level of the FLD, which in most trades it's considered to be. It would be at the level of Friday's low. And here you can see it actually explains this in the text here. Entry would be at 70.73, which is the low price of the 21st of February 2020. So with an entry level there, that means that the only part of the move that we would actually catch would be that tiny little piece over there. And so the way the system works is that T1 is calculated, as you know, using the entry level and the stop loss level and projecting downwards. If T1 is beyond T2, then that means that the cycle target will be fulfilled before you've really had a chance to actually make any profit. And so that's why it says that no trade is recommended. Of course, an F category trade is usually expected to exceed its T2 target, and so if you are feeling bearish, you might decide to take the trade anyway, which is why that information is provided there. But it made for an interesting example. I hope that makes it a little clearer, the whole situation of why sometimes no trade is recommended. Well, that's it for today. I hope that you found the video useful. Let me know if you enjoyed the style of video, and I'll do more of these. And on that note, have a great weekend.